Hello and welcome to yet another IFRS session from AARO Academy. My name is Frederick Tito, a senior IFRS consultant at AARO. So today we shall look at IFRS 11, joint arrangements, which is part of a host of standards that we train together as group accounting. Welcome. Our agenda for today shall discuss the objectives and scope of this particular standard, where we shall be discussing and dissecting what is the main reason for which this particular standard IFRS 11 was developed. Then from a scope perspective, we shall look to see what is within scope and what is not within the scope of this particular standard. Number two, we shall define what joint arrangements are. And while defining joint arrangement, you will notice that it is important the definition given to this particular issue, because the definition then defines the accounting for the particular types of joint arrangements. Then number three, we shall look at the types of joint arrangements, where you will notice that we have two types of joint arrangements, and the type determines the kind of accounting treatment that is given to the particular items. And finally, we shall look at how do you account for joint arrangements. We've already said that in accounting for joint arrangements, it depends on the type of joint arrangements. So then we shall look at these four topics, and by the end of the training, we shall be aware and we shall be able to account for joint arrangements. So now let's discuss the objective and scope of this particular standard. The main objective is to establish the accounting principles for reporting by entities that have interest in joint arrangements. Now, the main challenge here is the fact that when you are in a joint arrangement, you could be 2 or 3 people running one venture, and then the question is, how do you account for something that is co-owned or that is driven by 2 or more people? So this particular standard tries to objectively guide entities on how to account for such interest. Remember, you may invest in a particular venture at different levels. You may invest in a particular venture in a way that gives you full control or gives you partial control. But better still, you could still have contractual arrangements that allows you to then run such organizations jointly and make decisions unanimously. And therefore, there was need to develop an accounting principle, to develop an accounting policy that can be put in place or can be implemented when dealing with joint ventures. From a scope perspective, it's applied by all entities that are party to a joint arrangement. So if you are in a joint arrangement, then you have to think about IFRS 11 and apply it for accounting for your interest in that particular entity. The main goal of this particular standard, it requires an entity that is party to a joint control to do 2 things. First, to determine the nature of the joint arrangements through its rights and obligations that you can check through the contracts on these joint arrangements. So once you've determined the nature of the joint arrangement that you are in, the standard then requires you to account for those rights and obligations in accordance with that type of joint arrangements. So what we mean here is that you have to consider the first thing. What type of joint arrangement do I have? You'll notice you have 2. So once you have identified the particular type of joint arrangement you are in, the accounting then is dependent on the type of joint arrangement. Definition of joint arrangements. A joint arrangement is an arrangement in which 2 or more parties have joint control and exhibit the following characteristics. Number 1, parties are bound by contractual agreement. So there has to be a contract for you to say that you have a joint arrangement, and that contract will define the terms of the joint arrangement. Number 2, the contract gives 2 or more of the parties' control of the joint arrangement. So there are two characteristics that define a joint arrangement. Number one is that such parties must be in a contractual agreement, and that contractual agreement may give two or more. Notice that you could have a joint arrangement in which you have two people, or you could have a joint arrangement in which you have more than two people. But then the contract must give rights to run this particular entity to two or more people. So you could be even three partners, but only two have the contractual right to now run the entity. A joint arrangement takes two forms. It could either be a joint venture or a joint operation. In the next slide, we shall be looking at these in details. So now let's look at the types of joint arrangements in detail. And I will start with the most common one, that is a joint venture. A joint venture is an arrangement in which the parties, normally referred to as the joint venturers, have rights to the net assets of the arrangement. Now that means that they have rights to the residual income. So you have your sales, you have your expenses, you pay your taxes, and whatever remains, the residual income or the net assets is what is shared between the venturers. What of a joint operation? This is what is a bit unique. A joint operation is an arrangement in which parties, normally referred to as joint operators, have rights to assets and obligations for the liabilities relating to the arrangements. So in a nutshell, what do we mean here? It means then that in a joint operation, everyone accounts for the share of the assets that you bring to the operation, or your share of the assets that both of you bought together when you are starting such an operation. So now let's discuss how to account for joint arrangements. And in particular, I'll start with accounting for joint ventures. This standard requires you to account for joint ventures by recognizing as an investment using the equity method in accordance with IS 28, investment in associates, joint ventures, unless the entity is exempted from applying the equity method. So then what is this equity method? So as we look at the equity method, I want to take this opportunity to welcome you to register for our AARO trainings where we discuss the equity method in details. Now, as I've said before, joint ventures are supposed to be accounted for using the equity method. When you apply the equity method in getting the carrying amount of your investment in a joint venture, the carrying amount will be the initial cost you invested. To that amount, you had your share of comprehensive income. Remember, we had said you have a contract in a joint arrangement, and that contract defines how things are run in a joint venture. So then the carrying amount of your investment in a joint venture shall include the initial cost, as I've said before. You add to it your share of comprehensive income, and you subtract dividends. Now, let's discuss a bit about this formula. Initial cost plus share of comprehensive income minus dividends. Now, the initial cost is the amount you invested in that joint venture. The share of the comprehensive income shall be the outcome of your trading for that particular period under consideration. And finally, the reason why you remove the dividends is because the dividend form part of share of comprehensive income. If it had been included in your arithmetic, then you really have to remove it. That is it on the equity method. I would want to note that the equity method is applicable not only for joint ventures, but also when you are accounting for associates. That is one thing that we discuss in our AARO Academy trainings when we discuss group accounting, and please join our trainings, subscribe for our training so that we can look at the equity method in details. Where an entity participates in a joint venture but does not have control over the joint venture, it shall account for such investment based on IFRS 9 financial instruments, unless it has significant influence over the joint venture, in which case you may apply IAS 28, accounting for associates. Now, what do we mean here? It then means that there are certain instances where you could be party to a joint venture, but you don't have control. You don't form part of the joint control. You don't make decisions unanimously with the joint venturers. So therefore, you need to account for this particular investment based on IFRS 9. And when you join our training at AARO Academy, we discuss that in details. Now, what if you have significant influence over the joint venture? In that particular case, you are required to apply IAS 28, just like we teach in our group accounting suite of standards. Please join our training so we can look into such difficult concepts and make them easier for you to digest and implement in your day-to-day running of your organization. So then, now that we have looked at how you account for a joint venture, let's discuss how to account for joint operation. Now, you'll notice that in accounting for joint operation, it's slightly different from how you do it for a joint venture. Now, an investor in a joint operation is required to account for its share of assets, including those assets that they bought jointly. Again, such an entity is required to account for its share of liabilities, including those liabilities that are held jointly. Now, this standard is cognizant of the fact that an investor in a joint operation can either bring his own assets or team up together with the other joint operators to buy an asset together. So you will account for your share of assets which you brought into the business, or your share of those assets that you brought in jointly, those that you bought jointly together. And the same applies to the liabilities, where you will account for your share of the liabilities, but also those liabilities which are incurred jointly. In the statement of comprehensive income, an investor in a joint operation is supposed to account as such. It's supposed to recognize its share of revenue from sale of its share of output. So that is the output that is already assigned to you. You sell them out, the revenue from that. Number two, the share of revenue from sale of output by the joint operation. That is what is sold together in the joint operation. And finally, from an expense perspective, the expenses including share of those paid jointly. So one thing comes out: a joint operator is supposed to account for either the output or share of output that is sold jointly, its expenses, that is to mean those that the joint operator paid for individually, and again you need to consider those expenses which are incurred jointly. Now, I need to mention something. A party that participates in a joint operation but without joint control is also required to apply the split consolidation method that I've discussed above. Now, having said that, what happens when an entity changes from the proportionate consolidation that I've explained here for accounting for joint operation to the equity method? If at one point you reassess and you find out that now you need to apply the equity method, how then do you account for this? I invite you for AARO Academy trainings on group reporting so that we can dissect such scenarios and discuss in details and give you examples in Excel that can illustrate the technical concepts in an easier and simpler manner. So now let's recap on what we've learned today. We've learned that there are two types of joint arrangements. One can be a joint venture and the other one can be a joint operation. And we've said that in a joint venture, you account for the net income that you get from the investments. Your share of the net income is what you account for. Then on a joint operation, you do what others refer to as split consolidation. You take your share of the assets that you've brought into the business. You also take in the share of the assets that you bought jointly, and the same is repeated when you are dealing with your share of income and also your share of expenses. And finally, I now want to again welcome you for AARO Academy trainings, and just to highlight that at AARO Academy, we give you optimal pricing for our trainings, and we have dropped a practical approach to training. That is to mean that we give you practical examples and we share our experience with our students. And finally, we have subject matter expertise on the topics that we train on. Thank you very much, and once again, welcome to AARO Academy trainings.